Cele spoke to ECIC Chief Financial Officer Lesego Mosupye about trade and investment on the African continent.
Lately, with where the commodity prices are, we're seeing less demand for mining transactions, but there is a bit of a pickup in terms of infrastructure. But then again, that's also affected by the affordability of mainly African countries, which is our key market.
Coming back to the theme of driving trade and investment opportunities, though, how does this play comfortably into the hands of the ECIC in trying to mitigate risk?
Well, what we do is essentially mitigate risk for exporters and financiers. So risk is essentially our bread and butter. That's what we do. And for us, how do we look at risk? We look at it really from the long-term basis. So we analyze really the cash flow sustainability of these transactions in the long term. We do understand that our cycles, so we're looking through the cycles as a way of being able to understand and quantify the risk that we're exposed to. And to the extent that we are satisfied that the transactions are going to be able to be sustainable even under extreme cycle scenarios, then we'll be supporting them.
So given the pressures that we're facing at the moment in the current economic cycle, does this then present increased opportunities for the ECIC?
I think it's really just the opportunity will be driven by appetite for investment. So currently there is less appetite for investment given where commodity prices are, because the value of the project will be given by, the internal rate of return will be given by whether or not that particular project will generate funding. So with low prices, you get low economic returns. So if you put debt on it, maybe it's not feasible. So because of the low current environment, there's less appetite. But when you now switch into looking at perhaps other sectors where we weren't really too exposed to, like infrastructure, then you're looking at different metrics there. So there it's about government trying to build and capture the growth in the middle class, particularly in African countries and so forth. But again, that's impeded by the ability to borrow funds on the bond market or private market, or even just them being able to raise internal funding. So those are the key challenges. So then where are the opportunities that we have to look at? Then for us, it's about coming up with new products that tries to maybe create some kind of a pool for exports out of South Africa. So we're looking at supporting local banks and financial institutions in the African countries by providing sort of credit lines there with financial partners, and that allows them to have a, let's say, lending capacity in their local markets, and their borrowers then start to look to buy stuff, and they will buy that from South Africa. So that's sort of the new way of looking at trying to solve the problem we're facing.
Given concerns regarding the macroeconomic outlook on the continent, as well as ratings agencies perhaps not having a favorable outlook on certain African states, how does this impact or impede on the bankability of some of these infrastructural development projects?
I think it is significant in that you're now having sort of low demand for ECIC projects, so no one is sort of looking at these infrastructure projects. So, so from us, it means low volume of transactions. Our pipeline is low on that factor. But then you have to look at other types of projects. But that there are other projects where perhaps you have more support from the likes of the World Bank, and their significant projects. In that instance, when they step in, they probably don't look so closely at the short-term difficulties that those countries are facing, but they're looking more at the long term, and then we're able to participate in those sort of projects.